So we're here at the Silver Summit 2014 in Spokane, Washington. I'm very happy to have with me Mr. David Morgan himself, the silver investor. He's the main guy you want to talk to regarding silver. David, thanks for being here.
Thanks for asking.
How's everything going?
Going well.
Excellent.
Well, as can be expected.
Yeah, absolutely. So yeah, as you know, you've been here at the conference. A lot of topics have been covered, you know, on silver, and just want to get your feedback on you know, we're sitting at a price of around $17.50, and I just want to say how did we get here and where do we go from here?
Okay. Well, we got here from the market, and the market in silver and many markets are really determined from derivatives. Mm-hmm. So. And that swings both ways, in all honesty. I mean, if you've got a paper market that's very ambitious and you have a lot of buyers, you can send the price up. It'll be exaggerated because of the derivative exposure, and conversely on the downside as well. So the way we got here is the market forces be there what they are, not fundamentals, but the market itself is what's taking us to 1750. Because if you look at it fundamentally, nothing's really changed in the silver market. If you look at the GFMS report from 2013, the last year, what you'll find is we had about, according to them, almost 100 million ounce deficit in silver. So it's pretty hard to say, you know, with a deficit and fundamentals that strong, fundamentally, again, I'm just repeating myself, that the market should be at 1750. So how did it get there? It got there with the paper trade.
So how do we get to the mid-20s of where we were trading about a year and a half ago, you know, or the high 20s? How do we get there?
Well, I've been interviewed on, you know, this similar question, and you know, I took it. I don't know if Jim Dines originated or not, but Jim says the cure for low prices are low prices. Right. And it is, and that sounds kind of dumb until you think about it. But when you are in a commodity like silver, that the true costs are like $22 an ounce for 25% of the market share, then those companies cannot sustain. They are going to have to close down at some point. And when that happens, what happens to supply? Well, 25% of supply goes away. I'm just doing a cursory overview, but the idea is very sound. So at some point in time in the future, it's not sustainable at that level. The price has to come up. It can come up because of, you know, trading. It can come up for a lot of different reasons. But if it just came up on fundamentals alone, it would be because the price can't be sustained. People can't make a profit at that level.
Mm-hmm. And you know, I guess some other factors that we're seeing now is that, you know, Asia is playing more of a larger role now in the world in terms of gold and silver trade, especially with the new commodity exchanges such as the Singapore Gold Exchange, the Shanghai Gold Exchange. And you know, just to mention, you know, I'll put up a chart and a graphic on the amount of volume traded of silver on the Shanghai Gold Exchange, and it outpaced gold by a lot. I mean, you're looking at in 2013, for example, there was a volume of 450,000 tons of silver that was traded in all the investment vehicles, and as compared to gold, it was only around about 100,000 or so. It's unbelievable the difference. So will that have an impact in terms of the silver price, or is it just providing more options for investors?
Physical market will take control at some point. Mm-hmm. It has to. I mean, that's the way it's supposed to be. I mean, the derivatives markets, the futures markets, and others, options, are supposed to be determined by or derived from whatever the asset is, be it gold, silver, soybeans, or whatever. But what's happened is that, as the expression goes, the tail's wagging the dog instead of the dog wagging the tail. And that's the condition we're in. But because there's such a high correlation in those markets, there's some paper, but it's mostly physical. Of course it will, because there is such a discrepancy between how many pieces of paper represent the commodity versus how much of the actual commodity there is. And since they have a very, I wouldn't say insatiable, but a very strong demand physically, it will have an effect. In fact, a lot of people are focusing in on the Shanghai Exchange. I think maybe a little bit more than is necessary. In other words, once the Shanghai Exchange goes, look out, everything's going to blow apart. Yeah. I wouldn't rule that out, But you know, I'm a little more measured in my analysis. It doesn't make me right. It's just you know, I got the gray hair. So I think now, will it have an effect? Potentially it will. Will it have like a dramatic effect? I doubt it. But it will have an effect. And again, to repeat, the real key to these markets is the physical demand. And we know something isn't right, especially on the gold side. When Germany comes forth and says, you know, we want our gold back, and the Fed says 7 years from now, and then you have Ampro Bank, the Dutch bank that had all this physical gold and said, no, you have to settle for paper. Something is amiss. And even though we know it as gold bugs, the mainstream press reports it. I mean, that was in the mainstream press. But no one seems to take note of it because they've been conditioned, they meaning the average reader or the average investor, that gold's meaningless. It's a barbarous relic, and who cares about it? Only the gold bugs. Well, the problem is when you have the derivatives exposure that we have now in the world, that is the problem. And they keep adding to the problem, or let me say it more succinctly, the debt bomb, or the debt problem. Something's got to give. The only question is how soon, and I think it's sooner than later. I think we've got maybe a sustainable situation for maybe a couple more years at most, and I would be surprised if 2014 was similar to 2007, with 2015 being the 2008. Now, I don't know for sure, but I want to give the flavor to people that follow my work that it's that serious again. Nothing has changed. In fact, the too big to fails are now too smaller amount of too big to fails. So the risk has been not mitigated, it's going the other way. There's greater risk now than there was when it was failing. I mean, my corny analogy on this, and in my view this is accurate, not only do we get to the cliff and fall over the cliff, we went over the cliff and it was lassoed and caught and then dragged up back over the cliff. That's what happened in 2008, in my opinion. And now we're on the cliff again. But the next time it falls over, there's no lasso. It's gone all the way.
Interesting. So let's step away then from the silver price itself, and let's talk about you know, the mining equity space as well. That is focusing on silver companies. So what can we expect from them? Do you think there's going to be, you know, we've seen some M&A activity in the gold space of late, you know, silver space being so small. I mean, what can we see from that going forward in terms of the miners?
Well, you'll see some M&A. I mean, Avito did one. There's been a few others. But really what you see so much in the silver space, because silver, the amount of primary silver mines is so small relative to, you know, gold even, that really you look to silver and you see this model that isn't an M&A, but it sort of is in a way, meaning that, you know, they get a royalty payment because these companies need money to finance, to put the mines in production or increase production or whatever the variable is with a given company. Silver Wheaton is a finance house, and they say, we'll finance at this rate for these terms, and they come in. So do they acquire the company? No. But what is a silver company? A silver company is a company that produces silver. And what do they acquire? They acquire the silver. Yeah. So in a way, you can think of it, the way I think of it, I'll say I won't speak for you, is this almost an M&A type of situation on a multitude of companies. And by the way, that's why we like that model so well, because a lot of the royalty companies can still make money. And if the company that they have the agreement with can't produce silver, Wheaton's been pretty big-hearted in a way to kind of not let it slide necessarily, but to work within the framework of what the market's giving them at the time. Right. So I would say there will be some. I don't know of too many projects that are really huge that aren't owned that would be gone after. For example, Navidad with Pan American. I mean, that was a very juicy situation. If that was sitting there without being acquired, I'd say look for somebody to get that. We did an article in a Morgan report not too long ago about the acquirers and the acquirees. Right. And I forget how many there were, to be honest with you. We had, I think, 4 or 5. And I think 1 or 2 of them have already come to fruition. But there aren't a lot of great projects out there on the silver side that are just...
You haven't seen many discoveries even itself.
No, I mean, there have been some good ones, of course, but you know, we're talking 10, you know, a decade or even 15 years. There haven't been that many big silver discoveries. I mean, Pascua has been known for a long time.
Right.
Navidad was a big discovery. Corner Bay was a big discovery. You know, but that's, you know, the mine that Western Silver had with Gold Corp taking it over. But and then of course on the gold side there's been others. But we were having dinner at the banquet last night that's sponsored by Hecla, and Hecla, and they said the 10 years gone by too. So there's just, they don't say there's nothing left, but they imply almost that. They say, that'd be exaggerated, they said there's really no big deposits left.
Right.
Now there could be, no one knows that, but it's very difficult to find a big deposit. That's why a lot of these companies that are big NYSE companies do M&As. It's a lot easier for them to let some small junior go out and take all the risk. If they find something, buy it out at some kind of a premium, which in the long term is still viable to the a major miner.
Right. So it looks like with all these factors coming together, I mean you have these Asian commodity exchanges. So where do you see the silver price next year?
I really do. I don't think it can stay at this level much longer. But I've been wrong in the past. I mean, when we ran from the $19 breakout level, which I did that trade, and it got up to 26, and it was kind of floundering, and I got out. And then QE2 was announced. I got right back into 26 and rode all the way up to 48. So I rode that 19 to 48 move, which is a big move. When we got up there and I called the top at 48, I said, look, it's going to probably take 2 years for this market to consolidate. It's been 3.5. So I think it's about at a level time-wise. I'm not a big cycle theory kind of guy, but I've been in the markets for 40 years. And I think we're probably near the bottom now, or probably maybe the bottom behind us, I don't know. But I think we're close. So I really think because it's under the cost of production for a primary silver producer, everyone and his brother thinks it's going lower. The turnout at the conferences is as poor as I've seen since I started. I think there's lots of reasons to think that the bottom is here or very close, and that next year you can expect higher prices.
Excellent. Well, on that note, thank you so much, David. If you want to find out more information on his newsletter, you go to silver-investor.com, correct, right? And you can sign up and find out more about David Morgan. We'll provide the contact information. And thanks a lot, David. Appreciate it.